Imagine waking up tomorrow and discovering that the world's currency you rely on is losing its grip, that the greenback, the mighty United States dollar, might be slipping, and a challenger is quietly rising. That challenger is the Chinese yuan, also known as the renminbi. And yes, a currency war is already underway. In this episode of Vectorlog, we dive into why China is moving away from the dollar, how this affects you, your investments, and global markets, and what you should do now if you don't want to be blindsided. To understand what's playing out, we need to rewind and recap how the US dollar achieved its dominance. Since the aftermath of World War II, the dollar has been king of international finance. It's the world's primary reserve currency. Major trade invoices are denominated in dollars. Major commodities like oil, gold, gas are priced in dollars. This gives the US enormous leverage economically and geopolitically. For decades, global exporters and importers, central banks and investors have relied on the greenback as the safe harbor. That status doesn't just happen, it reflects trust in US institutions, deep financial markets, safe haven demand, and network effects. Everyone uses it because everyone uses it, but no empire lasts forever. And in the 2020s, we are seeing cracks, especially as other powers decide they don't want to be beholden to US financial hegemony anymore. Enter China. Over the past decade, the Chinese leadership has made it clear they want the Chinese yuan renminbi to play a much bigger international role. This isn't just about currency appreciation or depreciation, it's about rewriting the rules of the global monetary system. There are three big strategic motivations behind China's push. 1. Reduce USD dependency. If many trade deals, reserves, and investments are done in dollars, then US policy, US sanctions, US monetary policy have outsized influence on China's economy. 2. China wants to insulate itself. Export advantage. A weaker or controlled yuan helps Chinese goods remain cheaper for foreign buyers, boosting exports. While that carries costs, imports get more expensive, inflation risk goes up. Export-led growth has been the engine of China's rise. 3. Geopolitical leverage. A stronger yuan, or simply a more internationally accepted currency, gives China more say on the global stage. If countries trade bilaterally in yuan, then US sanctions tied to dollar payments lose some bite, and we are now seeing concrete evidence. For example, China's financial system is promoting the yuan for trade settlement, expanding swap agreements with other countries, building alternative payment networks that bypass traditional dollar-dominated systems. So, while the dollar isn't disappearing overnight, China is playing the long game. In recent months, analysts have flagged that China is ramping up yuan support via its central bank, setting stronger fixings, defending the currency, especially as trade and geopolitical tensions intensify. At the same time, China is actively resisting pressure for the yuan to appreciate, meaning it is managing the currency with an eye on stability rather than letting it float freely. Another big head-turner, the silent war of de-dollarization. China is pushing into Africa, Asia, and other regions, setting up direct yuan trade arrangements bypassing the dollar for some transactions, and perhaps most dramatically, digital currency. The battle isn't just physical exchange rates, it's about digital rails. China has developed the digital yuan ECNY cross-border settlement systems and is competing with the dollar's entrenched network of payments. Put it together: currency fixing, trade settlement in yuan, alternative payment systems, and you have the makings of a shift in the global monetary architecture. Let's break down what this shift could mean for economies, for investors, for everyday people like your viewers. Here are the risks. A weaker dollar or a less dominant dollar can cause global capital flows to shift. For countries heavily reliant on US dollar-denominated debt or trade, this could mean increased volatility. Currency wars often accompany trade wars or geopolitical tension, abasement, tariffs, sanctions, all of which raise risk for markets. If markets believe China is preparing for yuan appreciation, or if the dollar were to suddenly lose safe haven status, you could see unexpected currency moves, inflation consequences, and shocks to emerging markets. For example, the key level for us Dornai is being watched by analysts as a breakout point for global risk opportunities winners. Investors holding assets denominated in yuan or Chinese securities might benefit if the yuan strengthens or internationalizes further. Countries trading heavily with China may profit from cheaper Chinese goods or easier bilateral settlement in yuan. Commodities priced in dollars like gold, oil might see price pressure upward. If the dollar weakens, this could create hedging opportunities. Ask yourself, are you vulnerable because you are dollar-centric? Should you diversify exposure into other currencies or assets? What are the implications for import or export businesses or for savings held in dollars? The bottom line, this is not just about watching a chart, it's about tracking the power balance between the US and China, and that affects the world financial system. Before going further, let's clear up some common misunderstandings. Myth 1, the yuan will immediately replace the dollar. Reality, while the yuan is rising in prominence, it still has major hurdles: capital controls, less mature financial markets, less trust, and far fewer cross-border transactions compared to the dollar. So full replacement is unlikely in the near term. Myth 2, China wants a strong yuan at all costs. Reality, China often wants a stable yuan, not necessarily a rapidly appreciating one, because too much appreciation would hurt exports, create deflationary pressures, and risk capital outflows. Myth 3, a falling dollar means instant chaos. Reality, currency shifts are complex and gradual. Even if the dollar weakens, the transition period can be messy but not necessarily cataclysmic, though risks rise. US-dollar exchange rate, particularly significant levels like 7.25 minus 7.35 per dollar are being flagged. China's daily currency fixing set by People's Bank of China changes, and this can signal shift in policy. Trade settlement currency breakdowns, how much trade is being invoiced in yuan versus dollars, swap arrangements, and bilateral currency agreement, CG, China signing with African countries, other nations, digital currency adoption, how the ECNY and China's cross-border payment network are being used internationally. Capital flows and foreign reserves, whether China is accumulating assets, selling dollars, defending the yuan. Step 1. Review your currency exposure. If you hold savings, bonds, or assets denominated in US dollars, ask, what happens if the dollar weakens further? Consider whether you should have exposure in other currencies, yuan, euro, Singapore dollar, etc., but only if you understand the risks. Step 2. Diversify assets. A weakening dollar often boosts commodities like gold and silver. Some investors treat this as a hedge. If you believe the yuan internationalizes further, consider China or Asia-focused assets, equities, bonds, or ETFs, but highlight that this carries risk. Step 3. Monitor trade and business implication. If you're living in a country that imports many US dollar-priced goods or exports to the US, changes in currency value will affect you directly. Companies with dollar-denominated debt might face higher cost if their local currency weakens. Step 4. Stay informed. Policy and geopolitics matter. Currency wars are as much about policy as macro numbers. Sanctions, trade deals, tariffs, digital currency regulations all matter. The transition isn't just financial, it's geopolitical. Encourage your audience to keep an eye on China-US relations, BRICS developments, digital currency regulation. Step 5. Don't overbet it. While the theme is big and important, timing such macro shifts is notoriously difficult. Encourage caution, balanced portfolios, and long-term thinking rather than big speculation. Let's zoom out and think long-term. What could global finance look like if the yuan gains ground and the dollar's dominance diminishes? A plurilateral currency system instead of one dominant global reserve currency. We might see a basket of currencies: dollar, euro, yuan, maybe others used in trade and reserves. More regionalization. Trade blocs might prefer local currencies, and regional settlement systems dominate instead of global US-centric systems. New payment rails and digital currencies. The rise of central bank digital currencies, CBDCs, changes how cross-border payments work. China's ECNY and its cross-border bridge system are examples. Decline of US leverage via dollars for the US. A weaker dollar or less global demand for dollars means higher borrowing costs, less policy flexibility, and potentially greater inflation risk. These shifts will take time, likely years, but the fact that they are in motion means smart investors and informed citizens should not ignore them. The currency war is not a dramatic boom and crash story, at least not yet, but the battlefield is being prepared right now, and it's moving in plain sight. If you pay attention and make informed decisions, you won't just watch the wave, you'll ride it. Thanks for watching this episode of Vectorlog. If you found this helpful, hit like, subscribe, and drop a comment about what currency you think will dominate in 2030. I'll pick a few comments next week and feature them in the next video. Also, make sure you turn on notifications so you don't miss our upcoming deep dive into digital yuan versus dollar stablecoins, the next financial frontier. Until next time, stay informed, stay ahead, and I'll see you in the next Vectorlog video.